Hi guys, thank you for watching. Making this video today because I wanted to talk to you a little bit about investment fees and more so to compare these low fee robo-advisors that you see online all the time to traditional mutual funds. Just because some of them claim that you might retire 30% wealthier by paying lower fees. So I just wanted to break that out and see if it's actually true, the claims that they make. Okay, the idea is not to promote any service or business or company, but rather to have a very objective and unbiased comparison of the two, okay, with information that's available online. Okay, so first of all, I wanted to start with the two of the similar robo-advisors that they're kind of competition with each other. One of them is this one, you may know what I'm talking about, and the other one is this one. Okay, so to create a comparison, I'm using the hypothetical growth of $10,000 between August 2014 to November 30th 2018. Okay, the reason why I have these dates because these are the dates that these companies had available on their websites when I made this video. Okay, both companies claim that those two investments are net of all fees. So that's basically what I'm going with, okay? And I'm here to compare two of their portfolios that each of them have, their growth portfolio and their balance portfolio. Now, for the first guys, they claim that after fees during this investment period, the growth of $10,000 would have been equal to $12,699. Okay? And at the same time, during the same growth period, they claim that their balance of their balance portfolio would have been $11,478. Okay, so this is for these guys. Now, when I compare it to these guys, growth portfolio would have a value of $13,124. Now, the balance portfolio, they claim that during the same time period, 10,000 would have grown to 12,638. So these are both growth and balance portfolios that have similar asset allocations. They're low-fee ETF portfolios. So when you compare these two, you'd see that you're probably better off with this one if you were just to compare these two. But again, I said I was going to compare them to mutual funds, which are always claimed to be bad because they have higher fees. The problem with that is that a lot of the times, these companies, they market so much the low fees that they forget to emphasize on the most important aspect of investing, which is returns. How much are you getting after fees? Now, if you go to these companies' websites, they will show you online that, hey, you can make more than investing on the average mutual fund. Here's the question. When you're going to invest in something, are you going to invest on the average or are you going to invest on the best performing 4- and 5-star Morningstar rated funds? Okay, that is a real question. So if you were to compare these to the average, of course it's going to be better because for something to be average, that means that there have to be something better and something worse. So we're not going to compare this to just average. We're actually going to compare it to three different funds that are very well performing on their industry. Okay, just to be clear, these are what's called Class A funds. Class A funds or advisor series funds are funds that have a full commission for advisors embedded in them. So I'm not trying to show you low fee funds or anything. I'm showing you the traditional funds that people would invest with a regular advisor. Okay, I just happened to do some research and find actually good performing funds of the same category, growth and balance. Okay. And one more thing, these are not comparing it to just portfolios that I created myself. These are just a single fund of an asset allocation type growth and balance. And I will compare it with three just to point out that there's not just one superstar out there. Okay, so let's compare company 1, 2, and 3. And these are three funds, and they're actually not from the same company. I just put in 3 lines just so you can actually compare the results. So with the first one that I found, that it's a growth asset allocation fund, you would have had a return with a full commission advisor after fee return of 15,189. Okay? With another fund that I found that is a top performing 5-star fund, you would have had 15,000 and 53 with $53. Okay? And I'm going to show you in a third one that I found. $15,233. Again, these are all after fee, full commission funds. Now, when you, as you see on each fund compared to just the even the two companies, you have way more money after all the fees. Because one of the things that you have to understand when investing in mutual funds is that the fees, the returns that you see from mutual funds are always net of fees. They're after fees. A lot of people see the management fees and they think that they get deducted from their returns. That is not true. It's always after fees. So let's compare now the balanced portfolio. Same thing. I found one is 14,633, 13,786, and 13,749. Okay, so as you can see, also on a balance in a balanced portfolio, you would have almost twice the return on the same time period. And this is not something that took me a long time to figure out. This is just a quick search for 4- and 5-star rated Morningstar funds, put in the same date of investments, and look at the after fee return. And as you can see, you would have been way ahead investing in traditional mutual funds than all these 30% wealthier type of funds, because most of the time they're not focusing on performance, they're focusing on fees. Yes, you pay more fees here, but so what? You have way more money after fees. Okay, now I'm going to show you the third popular platform that is very common for robo-advisors. It's just because they have different dates, I just wanted to make a whole different comparison just to be objective again. Okay guys, so the third company that I'm going to compare, I did it separate because they actually have on their website a different time frame for reference. Now, what I could find, this is a comparison from January 2011 to September 2018. So we actually have like almost 7.5 years of data to compare it to. Now, I should mention also that this is the company that we're talking about, okay? Now, I should mention that once I actually read the fine print on this company's website, it actually clearly says that all the returns shown on their website are before fees, okay? I know that we're talking about having net returns, but I couldn't find that information anywhere. It says that the returns have not been deducted of fees. So I'm actually going to, just so you further see my point, I'm actually going to compare the before fees returns of this company against the after fee returns of traditional mutual funds for the same time period. And I'm going again to use the same growth and balance portfolios example. Okay? So for this guys, for the 7.5 years, $10,000 before fees would have grown to approximately $16,500 on their growth portfolio, and their balanced portfolio is about $15,700. So that's approximately a 65% gain overall in investment, and that's a 57% gain. Now, when I compare these two, again, two different top performing funds, and again, they're not portfolios that I created, they're just one fund, okay? If I compare their growth, one company would be 20,032, and the other one would be 23,801. Okay, and when I compare their balanced portfolios, it would be approximately 17,574 and 16,757. So again, in both cases, you see that the mutual funds, top performing funds, I should say, came out ahead of the game. And once again, these are not net of fees. These are before fees. These are after fees. So as you can see, even on the growth side, we came out with almost double the returns after fees with a top performing fund compared to these retire 30% wealthier type of funds. So what am I trying to say here? What is my point of this video? It's not to say that all mutual funds are better, okay? I'm going to say that, like I mentioned before, they always compare to average. When something's average means that there's something better, okay? And the point is that always consult with your advisor and make sure they're looking for your best interest, okay? Finding you the best performing funds, because they're out there, and these are just a few examples. I can find you tons more, or I can make portfolios that are better than that. But the point is that it's always better to forget about how much fees you pay and focus on the actual returns. Okay, a lot of the media, they're trying to emphasize fees. Well, guess what? I could have paid maybe 3 times more fees here. I don't care, because I'd rather have $23,000 than $16,000, and that's the whole point of investing. Okay, so if you have any questions, you can feel free to leave a message. I'll do my best to get back to you, and please have a nice day. Thank you.